Hi, my name is George Dagnino. The purpose of this presentation is to review recent trends in the business cycle. What is the implications for commodities, interest rates, and equity markets? Understanding what's going on in the business cycle is very important to figure out what is the best investment strategy. The investment strategy that you follow here or here is totally different from the investment strategy that you have when business is slowing down. So let's see now what the indicators are saying, the ones that have been released recently. The most important feature of the current position of the business cycle is the trend of inflation. This is the trends of inflation, 20+% in the last 12 months of commodity prices, producer prices of commodities. This is finished goods is around 15, 16, 17%. And this is the increase in consumer prices of roughly 9.1%. These trends are determining exactly what's happening right now to business activity and what is happening to the financial markets. Let me explain. Inflation is hitting really bad consumers. And this is the trend of consumer optimism. Just released it for July, the preliminary data. And as you can see, the consumer feels very poorly about the outlook for the economy. And of course, this has an impact on how much they're going to spend. It is not a coincidence that small business optimism is also sinking at multi-years levels down really badly. Why? For the same reason that consumers feel poorly and they see rising costs and slower demand. Of course, as small business feels less comfortable with the outlook for the employment is really not improving at all. In fact, if you see here, initial claims have been rising since April. So that tells you the labor market is becoming a little softer. This is a critical chart because it explains why consumers are really hurting, and because inflation is hitting wages. And wages after inflation have come down, and they are now down more than 2.5% over the last 12 months. So consumers are hurting. Income is declining. This is the outcome of soaring inflation, soaring spending by the government during the pandemic. Justified or not, that's what the outcome has been. Of course, rising inflation reduces income, and you would not be surprised to see auto sales sinking. They've been sinking well ahead of every recession in the past. So this declining in auto sales is something very worrisome. This is another statistics showing how well consumers are ready to spend for big ticket items. This is what durable goods are. Well, the big ticket item is this red line, and is negative. In other words, the first thing that you do when your income declines is to reduce the purchases of big ticket items. So that means housing, refrigerators, autos, so the very expensive things. Overall, durable goods are almost flat, but the worrisome thing is consumers. Again, this is another sign they are really hurting. This is an interesting set of curves. The red one represents the yield curves, the difference between the 10-year and the 2-year bond yields. And of course, as you heard on the radio, is inverted. In fact, it's down here, inverting very sharply. But the interesting thing is, of course, the other thing that everybody knows, that the inverting yield curve really reflects an economy that is slowing down. Because again, consumers and small business are really hurting. And it's not a surprise that job openings are slowing down. So what the yield curve is saying is the economy, yes, is slowing down, and the outlook for employment is getting poorer and poorer. Of course, what is business supposed to do? Well, they have to cut production to manage inventories in the face of slowing demand. And these are the actual data. This is wholesalers' sales and wholesalers' inventories. The red line is inventories. Sales have been slowing down. This is, by the way, is all after inflation. And as you can see, sales are now growing less than inventory. Now, if you're a savvy businessman, what you do is cutting production because sales are not growing as fast as you wish, and obviously you're going to have inventories accumulation, and that's going to hit earnings. Therefore, this crossing is a signal that production has declined last month, and it will keep going down, and that's of course is bad news for employment. Of course, business before laying off people, they cut production hours, and this is exactly what is happening. The growth in average weekly hours worked is negative, so they're cutting production by cutting hours. Then when things get worse and worse and worse, they will start cutting people. As I mentioned before, the yield curve has been steepening quite sharply in the last several months because of rising short-term rates and long-term rates remaining fairly stable, and is now inverted. That means that the difference between the 10-year and the 2-year bond yields is negative. What does it mean? Well, if you go before all the previous recession, an inverted yield curve here and here is always anticipating a recession of some type. So what this line is saying, things are more likely to get worse than better. So what is the impact on commodities and interest rates? Well, this is a chart. The reason I put it all together is because the trends are all the same. Because the 30-year Treasury bond yields is the price of the commodity money. Copper, of course, is the price of copper. This is the price of lumber, crude oil, natural gas, and soybeans. And what you see is that beginning in 2020, they all started moving up as the Fed started printing money to support the spending programs of the government. So what you see is commodities going up, you see yields going up, you see lumber going up, you see crude oil going up, you see natural gas rising, and you see even soybeans. They put soybeans there because they're totally all different markets. This is housing, this is farm, this is energy. But the point I'm trying to make with this chart that all commodities move in the same direction in a business cycle expansion. Now what you see now, they're beginning to sputter. Yields, copper has been declining sharply, lumber has been declining sharply, oil is going nowhere, natural gas, big time decline, and soybeans as well. So the fact that commodities seems to be weakening, actually, no seems, they are weakening, may be telling that the business cycle now is slowing down quite a little more than before. So things are slowing down in a serious way. This chart shows the stock market, and this is the business cycle as I computed using stock market data, internal market data. And what you see, and the feature of this is that during the expansion of the business cycle, and this is the slowdown phase, this is the strong growth, and this indicator is saying the economy is slowing down, as also reflected by the weaker stock market. The same thing is here, and the same thing is during this period. Now, from a strategy viewpoint, I showed this in several articles that are also available in our website, that during these times, you want to buy growth stocks. During this time, you want to buy defensive stocks and bonds. What about the international business cycle of other countries in the developed world and their equity markets? Well, this is data published by the OECD. And what you see here, the business cycle, the global business cycle, is exactly the same as the US business cycles as shown in the previous chart. The same thing for China, the same thing for Euro and the Europe and Japan. The difference is that all major areas, China and Europe, they are coming down. So slower growth ahead. The only country that's showing, the large country that's showing decent growth, I mean survival level of growth, is Japan. Now, as this relates to the stock markets, I show in my publications how all the stock markets have major peaks all at the same time, which coincide exactly with their business cycle. All of them. Some are growing faster than others, but the major tops and major bottoms, the turning points, are all the same. So really what I've shown is that really we are in this phase. This phase is characterized by big top in commodities. Inflation is still rising here, but eventually will decline. The economy is weakening because of rising inflation and declining income. So we are far away from this point where things will turn around and be positive. So still probably is the worst part of the business cycle, because this is the time that we are paying the piper and we are trying to clean the thing and get inflation under control again. So we have to hang in there. I will try to update you in another couple of weeks when we have new data. I hope you enjoyed this presentation. Please do keep in touch. I enjoyed doing it. I hope you enjoyed listening to me and to my crazy accent. Okay, take care. Bye-bye.